Welcome to this explainer. You know, if you've ever stared at a company's annual report and just felt like, well, like you were staring at a giant wall of random numbers, you're definitely not alone. But today, we're going to flip the script. We're going to look at financial statements differently. Basically, we'll treat them like a crime scene, just waiting to be investigated. We're building a toolkit to help you look way past those shiny top-line numbers so we can uncover the true, hidden story of a company's financial health.
All right, let's just dive right in by challenging a really common assumption about a company's bottom line. I mean, our intuition tells us that bigger is always better, right? If you see a massive profit figure, it's so easy to just assume, hey, the company's thriving, everything's perfect. But as financial detectives, we really can't just take that bottom line at face value. So, look at this. It's super easy to assume more profit is the ultimate goal, but massive absolute numbers? They can actually hide some wildly inefficient investments. Take a look at Company A. They made 100 core, sure, but they only spent 500 core to do it. That's a highly efficient 20% return on investment. Now look at Company B. They pulled in a whopping 1,000 core in profit. Sounds amazing, right? But wait, it took an enormous 10,000 core investment to get there, yielding only a 10% return. When you actually measure the profit against the effort it took to earn it, Company A is the absolute winner here. Absolute numbers can be totally deceiving.
Okay, so here's our roadmap for becoming master financial detectives today. We're going to cover 1. Why analyze financial statements. 2. Essential financial analysis methods. 3. Decoding clues with ratios. 4. The DuPont analysis model. And finally, 5. Hidden traps and limitations.
All right, Section 1. Why analyze financial statements? Let's start with the motive here. Why exactly do we need to look past those shiny numbers in the first place? And honestly, who's actually doing the looking?
Well, every stakeholder arriving at our financial crime scene has a totally different motive for interrogating the numbers. Lenders, they're digging into the data with basically one goal, making sure the company has the actual cash flow to repay a loan. Shareholders, on the other hand, are hunting for future growth prospects and solid returns on their investment. Then you've got the government checking in to see if an industry is performing well or spotting if a company is becoming, sick. And then there are small individual investors. Because deep analysis takes a ton of time and expertise, a lot of small investors simply outsource this detective work to mutual funds.
Moving right along to Section 2, Essential Financial Analysis Methods. Let's open up our toolkit and look at the different methods we use to normalize the scene. Because when companies are of vastly different sizes or maybe use different accounting methods, how do we actually make fair apples-to-apples comparisons?
One of our absolute best tools for this is the common size income statement. What we do here is literally take every single item and shrink it down to a percentage of a common base figure. In this case, total sales. Just look at the profit row. By completely neutralizing the sheer size of the company, we can clearly see the profit margin expanding from 3% in 2001 all the way to 6% in 2003. This technique is a total game changer. It makes it incredibly easy to compare a small local business directly against a massive industry giant.
We also use a few other specific techniques to track our suspects over time. We use trend analysis, or time series analysis, to spread the financial statements out year to year. This is great because it helps us spot creeping negative patterns. Think like a slow, dangerous rise in long-term debt without a matching increase in assets. We also use comparative, or cross-section analysis, to benchmark a company directly against its competitors or industry averages. Basically, we look horizontally across multiple periods to spot momentum and vertically within a single period to see exactly how a company's components are distributed right now.
All right, up next, Section 3, Decoding clues with ratios. Once we have all that data standardized and spread out, it is time to apply our core interrogation technique to really examine performance. Ratio analysis.
Now, crucially, ratios are not magic 8-balls. They're just signals or clues rather than the definitive answers to complex questions about a company. They won't solve the case for you immediately. Actually, a bad ratio rarely tells you exactly what went wrong, but it acts like this giant red flashing light, pointing you right toward the exact operational area that needs further intensive investigation.
To make sense of the whole shebang, we condense massive amounts of complex financial data into these specific ratio categories. First, liquidity ratios. These tell us if the company can survive the short term and pay its immediate bills. Then, profitability ratios, like the return on investment we touched on earlier, show earning power against the money invested. Long-term solvency ratios measure the risk and stability of the company's leverage and debt. Activity ratios tell us how efficiently assets are turning over, like how fast are they selling inventory. And finally, coverage ratios. These reveal the safety margins available for paying things like fixed interest and dividends.
Okay, Section 4, the DuPont Analysis Model. Sometimes calculating dozens of different ratios can leave an investigator completely drowning in numbers, kind of losing the forest for the trees. And that brings us to advanced financial analysis models, basically the master decoder ring of our explainer.
Enter the DuPont model. This is a highly structured and guided form of ratio analysis. Instead of looking at 20 different ratios in complete isolation, the DuPont model condenses profitability, productivity, and risk into one single, unified framework to reveal the overall, true performance of a company.
Visually, it's like a giant puzzle coming together from the ground up. You can see how the very basic, granular building blocks at the bottom, things like raw materials, current assets, daily sales, feed upwards. They combine to form your profit margin and your asset turnover, and those in turn merge to determine your leverage and return. It's a perfect, holistic map of how daily operations filter all the way up into the ultimate financial reality of the firm.
Following this model is surprisingly logical. Step 1, you multiply your profit margin by your asset turnover to calculate your return on investment, or ROI. Step 2, you factor in the impact of your leverage, which is your financial risk. And step 3, you combine these to determine the final return on net worth. By tracing this path backward, if a company's final return suddenly drops, you can pinpoint exactly why. Was it caused by shrinking profit margins, sluggish asset turnover, or maybe a dangerous spike in debt? You'll know for sure.
Finally, Section 5, Hidden Traps and Limitations. Because before we close the case, we really must pause. We need to caution you that even the best, most structured detectives can be misled by false clues.
You have to remember that financial analysis is inherently based on historical figures, and projecting the past into the future, well, it's never a foolproof science. As a stark reminder, despite having access to deep analysis and endless data, the world's top economists were completely unable to predict the recent Asian economic implosion. So keep in mind, financial statement analysis has very real limitations.
As you do your own investigations, you gotta watch out for these rapid-fire red flags. First, beware of window dressing, creative accounting and financial scams designed purely to hide the truth. Don't forget that inflation and seasonal trends can heavily distort a balance sheet if you aren't adjusting for real-world timing. Be incredibly careful with divergent policies. You can't easily compare companies with completely different fiscal years or accounting methods. Also watch out for diversified segments. Trying to compare a multi-industry conglomerate directly against a single-focus business is a trap. And lastly, avoid the one-way trap. Assuming a ratio that looks fantastic today will infinitely improve into the future is a major pitfall.
So you now have the essential toolkit. You know the absolute need for analysis, how to standardize data with different methods, apply the precise ratios, utilize advanced tools like the DuPont framework, and watch out for those hidden traps and limitations. So, what hidden truths, operational efficiencies, or lurking risks are sitting in the balance sheets around you right now? The numbers are there, they're just waiting to be interrogated. Thanks for joining me on this explainer, and happy sleuthing!